Hey guys, welcome back to Mark's Stock Review. Hope you're doing well today. This is going to be an update video on Exela Technologies. I'm going to be going over price targets and updates since my last video on January 16th, including the $90 million deal announced this past week. I'm also going to provide you a few key metrics to look quickly for when the earnings report is released, in case you plan on trading that day to take advantage of the volatility. And as most of you know, I'll keep the video as brief as possible without fillers to respect your time, so a thumbs up and subscribing if you haven't already would be greatly appreciated. So that said, let's get right into it. During my first video, there was only one analyst price target of $1.55. Now there's still only one analyst price target, but it's jumped all the way up to $4.65. It's still significantly higher than the current share price, plus it looks to have been placed prior to the announced $90 million deal this week. You clearly have to take this with a grain of salt since it's only one analyst. However, it may serve as a catalyst for Xela, as they're likely to attract more analysts in Q2 and Q3. I'm not going to get into the digital solutions they provide on a cloud-based platform. However, I will leave a link to my previous video if you'd like to see more information on that. In my previous video, I mentioned that Xela needed to concentrate on their two main sources of revenue, banking and finance, and healthcare. And they did just that. This week, they announced a 10-year, $90 million contract with an unnamed major U.S. health insurance company, which is also part of a broader relationship that included $28 million in 2020. It's going to involve blending automation technologies, software as a service, and services through their PCH global platform, which is their digital exchange platform. It's going to involve end-to-end processing of complex health insurance claims and multi-channel correspondence between the insurance company and provider and member networks. And if you remember from my first video, I said that their niche is their ability to connect two massive automation systems, so this fits in very nicely. And the last thing that I want to say about this deal is that it's part of a long-term plan to bring existing and future healthcare relationships to their cloud network in order to improve scalability and to build a self-service model platform for accessibility. So for the bottom line, this is more than just a deal. This is actually a key component of their long-term growth strategy. Moving on, in my first video, I mentioned that divesting was really important for Xela, and they had made some progress with that. They did sell their tax benefit group for $38.2 million. Since then, minimal divesting and asset sales, so that's something you're going to want to look for in 2021 and see if it's mentioned in the upcoming conference call. I do think it's important for him to talk about this because much of their revenue is still concentrated in less profitable areas. So from my point of view, they still need to continue divesting and reorganizing. And one more thing before I get to the earnings report is that previously I had said that the combination of Xela being a mature company and unprofitable, plus not having strong revenue growth, was a big headwind for them. And don't get me wrong, it's still a major concern. However, the deal announced this week is a huge step in the right direction. I now want to lay out a few key metrics to quickly look for when the next earnings report is presented. These metrics were identified by Xela's management as critical for the near term, so you want to be looking for these first, especially if you plan on trading during earnings report day. And these are going to be gross margin and whether cash flow is improving and whether liquidity is improving. And that last one's really important because that's the ability to pay off their short-term debts. And if they can't do that, that's going to lead to capital raises and ultimately share dilution. And also keep in mind that Q4 total revenue is expected to be about $300 to $310 million. I'm also looking for the top 100 customers as a percentage of the total revenue to decline. That's going to lower risk by decreasing the dependency on a select few customers. I'm also looking for higher growth in the more profitable sectors, banking and financial and healthcare, which are currently 26% and 24%. So looking for those numbers to increase. And regarding their healthcare business, per management, quote unquote, from a demand standpoint, we continue to see some very encouraging signs in Q3. So you want to be looking for this to be confirmed during the next earnings report and conference call. And note that the healthcare solutions segment revenue was up 10.2% from Q2 to Q3 in 2020. So that's going to be your reference point, 10.2%. And the last thing to look out for in the earnings report and conference call is the digital asset group growth. Management sees this segment as lucrative and high growth, so be keeping an eye out for comments on this. In summary, number one, they need to continue strengthening their position in key industries, which I discussed. And number two, Xela is still in a period of price discovery since the deal was announced this week, so be very careful of price targets and technicals as they can be less reliable during this time period. I do agree with the price target from the one analyst. However, Xela is still in a period of transition, plus I do expect high volatility, so I would consider spreading out your trades over a period of time to average out your cost basis. And that does it for my update video on Xela. I hope you guys found it helpful and informative. If you did, please consider subscribing and hitting the thumbs up. I greatly appreciate it. I'll have a new video out in a few days. So that said, have a great rest of your day, and I'll talk to you soon.